On this week's edition of the Industry Leader Update, part 2 of our exclusive interview with the mortgage professor, Mr. Jack Guttentag.
But I fear for what happens or what may happen with that situation when we begin to have severe rate spikes.
Absolutely. So you did mention, that was my next question, is the 120-day, which is typical expected rate lock. So in that environment, do you think that would be a challenge for people to offer to the consumer?
Well, I think it's a good idea to distinguish two types of reverse mortgage applicants. One type of applicant will be aware of the rate situation and that they are not locked. And when they get to closing or to the lock date, shortly before closing, they will discover that the rate is far beyond anything that had been suggested to them earlier, and they will feel that they have been deceived. They weren't deceived, of course, but on the other hand, nobody was very explicit either about the risk that they were being subjected to.
Absolutely.
But then there's the other category of applicants who are focused on the amount, who overlook the rate and take down their mortgage and don't discover that the rate had increased on them until they see how rapidly their debt has been growing, and they're going to be possibly aggrieved well into the future when they discover this. So, although their focus on the amount rather than the rate will reduce the immediate negative fallout of a rate spike, what it does is to push the negative implications into the future, which is something I think to worry about.
And this could be a big PR nightmare for our industry. And of course, we've just begun to tackle the public black eye from technical defaults and those issues. So I'm sure you have some ideas. I know that you've thought about on how we might be able to mitigate this problem. Is that correct?
I think you're right when you say that this could be a PR nightmare. And they'll likely portray it as one more example of greedy lenders taking advantage of seniors. And I would be even afraid that some legislators might view it as a good reason to phase out the HECM program. So what do you do to prevent this sequence? One thing that badly needs to be done is to develop and deploy longer lock periods, at least comparable to those available in the forward market.
Interesting.
But that will require an industry effort, and that effort has to include the secondary market players, including Ginnie Mae. So it's something that could take years, even if the process were to start tomorrow. The other approach, which can be adopted by individual lenders, is to provide an early disclosure that makes it crystal clear to applicants that they assume a rate risk associated with market volatility, but that market volatility works in two directions and borrowers will benefit if rates decline. I have tried my hand at a disclosure that on one page makes that case pretty clearly, and I'm happy to send it to any lender who requests it. I want to make one other point about what individual lenders can do, because even if they put their applicants on notice that they're exposed to a rate increase, the applicant is not going to feel very comfortable if he doesn't have access to current information about what his rate is. They should be able, applicants in process should be able to monitor their rate right to the date when the rate is officially locked. So to me, that means that lenders ought to be deploying the technology, which is readily available, that would allow their clients to monitor their own rate during the period when they're waiting for the loan to lock.
Now we have the amortization tables. What are your thoughts? And this, I know this is a little off topic, Jack, but I thought I would ask the professor. Is what our amortization tables for our industry have been very static, but do you think there's value in being able to provide a what-if scenario where we may have an interest rate spike so people can see the effects? Is there value in that for the consumer?
I think there is. A senior who's making a rational decision, not only as to whether or not to take a reverse mortgage, but if they do decide to take one, what combination of options they want to accept. There's value in being able to see the implications of those choices in their financial status in the future. And the HECM calculator that I have on my website allows a senior to do that. And I should know that to my knowledge, it's the only calculator available that provides that functionality.
And I know there's a number of options that the individual can take that will dramatically affect their amortization. One, of course, is lump sum, which the recent revision to the HECM program has discouraged with distribution limits. And then, of course, we have tenure, and then kind of a hybrid plan or modified tenure with a line of credit. So it would kind of address some of those scenarios.
Yes. One of the features of a HECM that doesn't get the attention that it should is the credit line, the unused credit line, which grows at an interest rate equal to the actual rate on the ARM plus the mortgage insurance premium. And one of the implications of that is that the senior who takes most of his draw as an unused credit line is going to be benefited by rising interest rates in the future because his line will grow faster and he'll have more drawing power in the future.
Absolutely.
But this is something for the borrower who's looking ahead, who wants to use his HECM to help him in the future years. Unfortunately, a very large proportion of reverse mortgage borrowers have been focused on their current financial problems and have used up their borrowing power very quickly, leaving none of it for later when they may need help even more.
Well, I want to encourage each of our viewers today to visit the Mortgage Professor Jack's website. Can you tell us the web address again?
It's mtgprofessor.com or mortgageprofessor.com.
Excellent. And if you have questions or comments, as always, each week, many of you are interacting with us. Be sure to comment on this video below. And we want to thank you, Jack. I know your time is very valuable, and we were very fortunate to be able to secure an interview with you. Thank you so much for being part of the Industry Leader Update and also interacting with our reverse mortgage professionals here today.
Shannon, it's been my pleasure.
Thank you.